So the forces of globalization and also the deregulation of financial sector as well as the banking sector brought about various changes in the banking sector across the countries. So increased financial innovation and advent of new technology exposed banking sector to various higher risks. So this led to the harmonization of international capital standards which gained momentum under the aegis of Bank of International Settlement, which led to the adoption and introduction of BASEL norms. So in this series of concept पढ़ाएंगे सबको सिखाएंगे, we will be discussing about the BASEL norms. So let's proceed. Hello everyone, welcome to iExamB. So the concept for today's learning is about the BASEL norms. So BASEL norms, they apply to the banking sector, the banks across the various countries. So how did they come into being? What was the need for that? We will discuss in the session. So banking regulation, as we know, when we talk about the bank regulation, the main motive for the same is to ensure that bank keeps enough capital for the risk it takes. It is not possible to eliminate altogether the possibility of bank failing, but still there should be an effort made in place so as to decrease the actually to keep the enough buffer in place with the bank so as to deal with the probability of default or any other bigger risk. Right. So bank regulation is very necessary. So for the same, the BASEL committee, initially named the Committee on Banking Regulations and Supervisory Practices, was established by the Central Bank Governor of G10 nations at the end of 1974, and this was basically the trigger point was the failure of Herstatt Bank in West Germany. And this committee is headquartered at the Bank for International Settlements in Basel, was established to enhance financial stability by improving the quality of banking supervision worldwide. So it was international harmonization of the capital standards that need to be undertaken by the various member countries. So banking regulation pre-1988. Why pre-1988? Because 1988 BASEL 1, that is the first segment of BASEL, came into being. So before this 1988, bank regulators within a country tended to regulate bank capital by setting minimum levels for the ratio to total asset. What are the total assets? Assets, what we mean by here? That is the loans and advances that bank is making to the various customers. So there is always a probability of risk, a probability of default by the customers, because they might not repay it back. The reason can be any. So it might cause loss to the bank because they are making these loans and advances out of their deposits, and deposits can be demand deposits or time deposits. So these loans and advances need to be secured for the bank in order to avoid any rundown on the bank. So that's why banks need to maintain enough capital as a buffer, as a cushion against these assets, so as to withstand any kind of risk that is involved in payment of these assets or the loans and advances. Right. So earlier bank did not have any stipulated ratio or stipulated definition of capital to be maintained against their total assets. Right. So, and also whatever the ratio was considered was varying from country to country. Some countries were following the regulations more diligently, but on the other hand, some other countries were not. So whatever, all these banks had global presence. So then all those countries where the regulations were not stringent, they seem to have a competitive advantage over the countries where tighter regulations were followed. So in order to avoid this kind of arbitrage, this banking regulations, the standardized banking regulations possibility was figured out. So this Basel committee was formed in 1974, and the committee consisted of representatives from various countries like Canada, France, Germany, UK, USA, Sweden, etc. Various countries were involved. So the first, and these countries, the representatives of various countries, they kept on meeting, for various brainstorming about the introduction of these banking regulations. So it met regularly in Basel, Switzerland, under the patronage of Bank for International Settlements. So the first major result of this meeting was this document entitled International Convergence of Capital Measurement and Capital Standard. So this came to be known as BIS Accord, or later came to known as Basel I. So this Basel Committee on Banking Supervision is the primary global standard setter, because all these capital standards are adopted by the member countries globally, and they are the standard standard norms and regulations which would be uniform across the countries. Here and there discretion would be given to the central banks of the respective countries to make modifications about as per their financial system, but still the overall norms and regulations are standardized, right? So 1988 BIS Accord. So this was the first attempt to set international risk-based standards for capital adequacy. Capital adequacy. See, the words are two: capital and adequacy. Enough cushion in the form of capital needs to be maintained, and adequacy. The adequate capital should be ensured so that it should meet, it should be kept against those risk-weighted assets, and it should be sufficient for any bank or financial institution to cover its losses in case of any crisis. So the capital adequacy ratio is a measure to determine the proportion of a bank's capital concerning the bank's total risk weighted assets. So capital as per Basel Accord, which is popularly or which is mainly known as the regulatory capital, is sum of various components like tier 1, tier 2, and one point there was tier 3 also, which a bank is required to maintain. So the committee recommended a weighted risk ratio in which capital is related to different categories of assets on or off balance sheet assets, weighted according to broad categories of relative riskiness. So if loans and advances are made to certain segments like say government entities or so, as these entities, their risk of default is less, so the risk attached with these loans would be less. Let's say for example 0 to 10% only risk would be attached to the loans made to all these organizations. But on the other hand, some other loans are made where there is no collateral or where there is no security, unsecured loans are there, so where the risk attached would be much higher. So this is just an example. So according to that, these assets are put in various baskets, and as per the weights of risk attached to these assets, the capital would be kept against these risk weighted assets. So the ratio represents in the form of percentage. So generally it is considered the higher the ratio, the better the bank is placed in terms of safety, and the lower it is, that means it lowers the capability of a bank to withstand any kind of risk during the crisis. So the Basel I Accord required banks to keep a capital equal to 8% of the risk weighted assets. Mainly it contained of components like tier 1 capital, which is the core capital, and it comprises of only those components, mainly the equity, and which has the highest loss absorbing capacity. And then tier 2 capital, which is called the supplementary capital, right, is made of broad mix of near equity components and hybrid. Hybrid means like composition of debt and equity or debt instruments, right? So it is called the supplementary capital. And at one point of time there was tier 3 capital also, which was added in 1996 amendment, and it could only be used to capital required for market risk. Right, so various kind of risks are addressed in these Basel norms. We will discuss about that. So 96th amendment, basically this Basel 1 norm was concerned with the credit risk. Credit risk is risk against the default of a counterparty. So if any two parties are there and other party does not make a payment or there makes any default, right, so there is always a risk of non-payment of these loans and advances. So that is mainly covered by the credit risk. This is a risk of a counterparty. So 1996 amendment, after this 1988 various other changes were also discussed, and there was also a need for the same which was felt. So for that 96 amendment also came into picture. It was implemented in 1998 and was referred to as BIS 1988. So the amendment involved keeping market risk associated with trading activities. Market risk, bank has two kinds of books. One is a banking book and other is a trading book, right? So trading book involves various kind of financial instrument that a bank deals with, in which are marked to market, which changes its value according to the situation in the market. So that's why their value keeps on changing. So the discussion about the same, the keeping capital against these kinds of assets would differ from assets which are kept as in the normal banking book, like the normal loans and advances, right? So that's why these market risk was actually added in that, apart from the credit risk, in order to keep the capital regarding the same. So for this amendment was made. And then Basel 2, right? So Basel 2 also basically there were some lacunae in Basel 1 Accord, because it was in terms of that all loans by a bank to a corporation having a risk weightage of 100% and require the same amount of capital. Like for example, a loan is made to any kind of corporation which is rated AAA. So the capital against these the loan made to this corporation and capital made to the corporation which is rated B was the same. So in way there was no differentiation, and Basel 1 there was no model of default correlation. So that's why this particular thing was addressed in Basel 2 norm. So Basel 2 norm is actually the revisions were made in January 2001 and April 2003. Various other amendments were made, and it was mainly based on three pillars: minimum capital requirement, supervisory review, and market discipline. So in this also there was one more risk, which was operational risk. Apart from credit risk and market risk, there was one more risk which was addressed, which is lead to mainly risk because of the day-to-day operations or technical glitches or any frauds by the employees or any other stakeholders. So all these things are involved in the operational risk. This risk was also addressed. So in pillar 1, the minimum capital requirement for not only credit risk, market risk, but also operational risk was also calculated. So total capital was that needed to be maintained by the bank was equivalent to 8% of credit risk weighted asset, right? And then market risk weighted assets, and then operational risk. All those risks calculations and various methodologies were there in place. So that was their minimum capital needs to be maintained, that was 8%. And pillar 2 was concerned with the supervisory review process. It covers both quantitative and qualitative aspects of the ways risk is managed within the bank. And supervisors like central banks of a country are required to ensure that bank has a process in place for ensuring that capital levels are maintained at all the times. And market discipline is also made to ensure that there is enough disclosures. There is enough disclosures by these entities about the way they allocate the capital and how they manage the risk. So when they are made accountable to make disclosures to the various stakeholders like shareholders and other parties, they will be under more pressure to deal with all these aspects diligently, right? So then after that there was a Basel 3. Mainly Basel 3 is came into being after the global financial crisis of 2007 and 2009, because even after having the stringent regulations, banking regulations, various bigger banks failed. So then there was also a need to introspect that what went wrong and what could not be addressed by the previous two Basel 2 norm, Basel 1 and Basel 2 norms. So that's why Basel 3. So following this crisis, the Basel Committee realized that a major overhaul of Basel II was necessary. So Basel 2.5 increased capital requirement for market risk, because various kinds of derivatives and other structured products like financial products were culprits, were made responsible as culprits, which led to the global financial crisis. So that's why the need was felt, and it was given a short name like Basel 2.5, and that capital requirement for market risk, like all these financial instruments, there should be enough capital in place, right, in order to deal with various kinds of risk. And also Basel Committee wanted to increase capital requirement for credit risk, not only for market risk but also credit risk. And even the definition of capital was also amended, and also liquidity risk. Apart from credit risk, market risk and operational risk, one more risk was highlighted, that was liquidity risk in Basel 3 norms. And Basel 3 proposals were first published in December 2009, and there were 6 parts to the regulations: capital definition and requirements, capital conservation buffer, counter-cyclical buffer, leverage ratio, liquidity risk and counterparty credit risk. So this was actually Basel 3 was a part of 6 dimensions. So whenever, if you have any descriptive question, like for exams like RBI, grade B and all, so once if you get question on Basel 3 norms, if you define these according to all these changes and aspects, then it will give a better picture and better understanding, that you know the depth of it. So that's where it should be. So 6 parts are capital definition and requirement. So Basel total capital according to Basel 3 should be consist of tier 1 capital and tier 2 capital, and one more, that was additional tier 1 capital. Right, so basically it is called a common equity, as I have told you. This is the core capital of a bank. Mainly it includes the share capital, retained earnings, but does not include any kind of deferred tax assets or goodwill. So this tier 2 capital is a supplementary capital, and it is called a gone concern capital. Gone concern capital, that is basically when the bank is no longer a going concern, that is as a negative capital, losses have to be absorbed by tier 2 capital. Till the time this capital, which is called a going concern capital, it is positive, that means the concern will go on doing its business. It will not liquidate, or it will not go bankrupt. But this gone concern capital comes to light when this capital has gone negative, and losses have to be absorbed by this capital. So this capital ranks below the depositors. So if this capital is in positive, depositors, right, so when it goes into liquidation, then in theory all the depositors will be paid. Right, so there is also one more segment of additional tier 1 capital that was there in the Basel 3 norms. So tier 1 capital, as I have already defined you, it's called a going concern capital, and as per the master circular given by RBI in the month of April 2022, so this is the minimum that needs to be maintained by all the banks, Indian banks and foreign banks operating in India. That is tier 1 capital. This is 5% against the risk weighted asset, and then apart from this tier 1, there is also a capital conservation buffer, an additional tier 1 capital, and then tier 2 capital. So in total, minimum capital ratio that plus conservation buffer that needs to be maintained by the banks is 11.5% against their risk weighted assets. So what is capital conservation buffer? So capital conservation buffer, in addition to all these capital requirements that we have seen, Basel 3 also required a capital conservation buffer in normal times, consisting of further amount of core tier 1 equity capital equal to 2.5% of the risk weighted assets. So this provision basically is given to ensure that banks build up capital during normal time so that it can be run down when losses are incurred during the periods of financial difficulties, because the rationale was that banks are able to raise money effectively during normal times. So that's why they should do it, and then they should keep it as a buffer for difficult times, right? So this was a capital conservation buffer. Then counter-cyclical buffer. So in addition to capital conservation buffer, Basel III also specify the counter-cyclical buffer. This is similar to the previous one only, but the extent to which it is implemented in a particular country is left to the discretion of the central banks of the respective countries. And the buffer is intended to protection for the cyclicity of banks earnings. Like there is a variation, right, during the period normal times and financially difficult time. There is a cyclicity in the bank's earnings, and buffers can be set between 0 to 2.5% of total risk weighted assets and must be met with the tier 1 equity capital, right? And then leverage ratio. So apart from that, as whatever we calculate the capital requirement, that is made on the risk weighted asset. There is a risk weights attached to that, right? But leverage ratio was based on the is a ratio of capital measure to an exposure measure, not against a risk weighted measure, but the overall absolute exposure measure, right? So Basel III had specified minimum leverage ratio of 3%, right? It is a ratio of capital measure to exposure measure, right? So the capital measure is total tier 1 capital, right? So it will include is a sum of on balance sheet exposures, derivative exposures, off balance sheet items. So no risk weighting is required in such cases. Only the full exposure would be, so 3% minimum would be there. For even Indian banks also, certain ratios are also defined that needs to be maintained, because these are the standard ratios which are given by the Basel norms, that overall across the countries that they need to maintain. But in case of like India, the leverage ratio shall be 4% for domestic systemically important banks, and then 3.5% for other banks, like this domestic systemically important banks like SBI, HDFC, ICICI. All these are systemically important. For them it will be higher, and for other banks it is 3.5% as per the master circular of RBI dated 1st April 2022, right? So this is it. And then liquidity risk. So this was mainly the risk because the banks at that time during the global financial crisis, they had enough capital in place, but then they did not have enough buffer to meet their short term capital requirements, because all their investments were tied in the long term. So that's why there was a mismatch. So in order to meet the requirements, in order to address that liquidity risk, certain other ratios have been implemented, right? That was introduced two liquidity ratios. One is the high liquidity coverage ratio, and then is net stable funding ratio. All these ratios for long term and short term liquidity risk, these banks need to maintain. Actually they need to keep the high quality liquid assets, which might be investments in the securities like SLR and all, and they should meet the net cash outflow in a next 30-day period. So these kinds of ratios are also important for the banks to maintain. So other is counterparty credit risk. So counterparty credit risk, for each of its derivative counterparties, a bank calculates quantity known as credit value adjustment. So that is expected loss because the possibility of a default by the counterparty, right? So for that, each of the derivative, this credit value adjustment, counterparty credit value adjustment, this calculation was important. That was also a part of the Basel III requirements, because the severe risk arising from changing credit spreads to a component of market risk capital, that needs to be actually a part of changes that were made in the Basel III norms. So if required, we can actually have a separate video on the liquidity risk and counterparty credit risk in order to understand them in detail. So this was all about the Basel risk. So all these norms were made stringent in order to strengthen the financial system of every country, because globally they are interconnected with each other. So if any changes happen in one country, that have a spillover effect on other countries also. So that's why banks as the backbone of any country needs to be strengthened and robust. For that, Basel III norms came into being. And India also, this implementation has almost been done fully as per the master circular. So that is it for this concept. We will meet with some other concept later. Thank you. So prepare 50% faster with iExam-B and subscribe to the channel, and don't forget to press the bell icon, and you can have the look at the details wherein you can contact us for any of the courses provided by us. Thank you and all the best with your preparations.